Awesome. Well, we are here. Let's go ahead and dive in. Well, first, welcome. Good morning. We are live from the Manay CPA office in Marietta. I'm Rocío Brandau. I am Director of Sales and Business Development with Manay CPA. And today we are going to dive into the One Big Beautiful Bill Act and really just focus on some key highlights, some takeaways, just making sure that we are giving you guys what you need as this bill affects individuals, business owners, and really Al is our expert. So Al, we have Al Meyers CPA. He's the director for our tax side and tax strategy, and he has years of experience, of course, working with clients for both individuals, businesses, and I will turn it over to Al now just to kind of dive in. I guess starting off first, what is so important about this new bill?
Well, thanks for having me, Rocío. It's good to be here, everybody. This is like Santa carrying around, a big bag of toys. There's really something for everybody in this bill. It stretches across the whole spectrum. It's going to affect, high net worth taxpayers, business owners, young couples that are maybe starting a family or growing their family, certain blue-collar workers who work, say, in the restaurant industries or are paid hourly and thus eligible for overtime pay, and much more.
Awesome. So, let's start off with the individual side of things, right? Like, so I'm an individual, I'm married, I'm married jointly. How would this affect me as an individual? I guess starting with maybe the SALT deduction increases, we can just start there and how that affects us.
So, everybody has been hearing, in the news about all the debate that was going on about state and local tax deductions, known as SALT. So one of the things you're going to see, I think, out of this tax bill is a lot more taxpayers taking the standard deductions on their tax returns. So for those of you that know, you have the choice to either itemize your deductions or to take the standard deduction. The good news for folks is that the standard deduction has been maintained at those very high levels, over 30, 31K for certain folks. And in addition, you may remember during COVID, there was a 1 year where they allowed kind of a non-itemizer deduction for certain charitable donations that you might make. And those are coming back over the next few years. So if you are single, if you don't itemize, you can take, up to $1,000 of cash donations as an additional deduction, or $2,000 if you file jointly. But the state and local tax deduction was always for itemized. It was always, capped at $10,000, at least for the past several years. So what happened was there was a lot of, rancor, if you will, spirited discussion from some of the very high tax states, like California. I don't want to leave any out. California, New York, Massachusetts, New Jersey, whatever. You can go down the list, and they wanted a higher deduction. So what's happened over the next few years is that for those folks who do itemize, the state and local tax deduction is going to go up to 40K this year. So it actually starts in 2025, and then it will be adjusted each year for, for inflation. There'll be some 1% increase, I think, a year through 29, and then 2030 it'll go back down to 10. However, there are certain, income phase outs. So for low and middle income taxpayers, it will be very beneficial.
Okay.
But for the folks that are, over, let's talk about married couple, over 500,000 of your adjusted gross income, starting at 500,000, there will be a gradual phase down over the next 100,000. So the way it's going to work is, think about it as if you're over 500K, whatever that excess is, multiplied by 30%, and that's the amount that it's going to drop. Your 40K is going to drop. So by the time you get to 600K, it's back to 10. It won't go down below 10. But for folks that do want an unlimited deduction, we'll talk about it more later, the PTE tax, the pass-through entity tax, is unlimited for pass-through entity owners, and that's staying. So we'll talk more about that later.
Okay, awesome. What about auto loan deduction? How will that be
So that was one of the new things this year. So, one of the things that was always known to folks, other than mortgage interest, personal loans were never deductible on your tax returns. But what the new tax bill has done is if you buy a new car where final assembly was done in North America, then you will be eligible for up to a $10,000 deduction for the interest that you paid to finance that purchase.
But it has to be made in North America.
Yes.
So that's a big kind of nuance, right?
Yes.
We just want to make sure that's
and there's
clear.
Income phase outs. We don't got to get into the specifics, but but a lot of these changes we're going to talk about have income phase outs.
Okay. What about the child tax credit enhancement? Maybe talk a little bit about that.
So I wouldn't say that it changed a lot.
Okay.
Obviously, it's going up to starting at $2,200 this year, and it'll adjust each year. But the good thing was that what was maintained from the last tax bill was that the refundable component of that tax credit is still at $1,700. So out of the $2,200, $1,700 is what's called refundable, which means you're eligible for that amount whether you owe taxes or not, meaning you can get it back. It's not what's called a non-refundable credit.
Okay. So when we talk about seniors, so my parents are seniors. They are in their 70s and actually 80s. How will this affect them as a senior?
So that was another one of the new things that was added to this new tax bill. Certain eligible seniors, and what a lot of these deductions and credits, you have to have a Social Security number. That is one of the things they mandated. But certain seniors that are below the income limits will get they will get a $6,000 additional deduction on their tax return, which is a new benefit for seniors.
Awesome. Okay. And then as we talk about tips, right? Tips, I know that there's some conversation about tips and overtime specifically. Tell us more about how those will be affected.
Right. So the good news is that there is now a certain deduction for a certain amount of tip income and overtime pay through the 2028 tax year. So for overtime, obviously any overtime that is required to be paid in accordance with the Fair Labor Standards Act, which is similar way it's always been. You will get up to, I think, a $12,500 deduction. And then for tips, for obviously folks in the restaurant industry in particular, you can get up to a $25,000 deduction for qualified tips. And that would include cash or credit card tips, and also tips that are considered what they call pooled tips. Folks in the restaurant industry know what that means. Both of these are going to require additional tracking and reporting for the employers to track these. But as long as your income is less than $150,000 for single, $300 for married filing jointly, this is going to be a very nice, basically you're getting a tax exemption.
Okay. Now, this is something that I really hadn't heard about, to be honest, as an individual taxpayer, is the Trump accounts for children. Tell us more about that. What is that?
So this new tax bill has created a new savings account. It's called a tax deferred savings account. And what's going to happen is, and you have to basically opt out of this program. So the one thing is, if a new child is born between 2025 and 2028, and they have a Social Security number, that you will see a $1,000 gift from the U.S. Treasury. So right off the bat, and they will, seed the accounts. These accounts, you have to opt out of these accounts. But these accounts will be they'll be invested in diversified, index funds mostly.
Okay.
So they're going to be very diversified and safer funds, if you will. You will be able to contribute up to $5,000 a year. And these contributions can be made by parents, relatives, employers, and it's after tax dollars. And the other big stipulation here is the beneficiaries can't take any money out until they're 18, with very rare exceptions that we don't have to get into today.
Fair. Okay. Awesome. And let's talk about rollovers and IRAs. How are we going to see that impact our savings accounts?
So, the 529s are going to operate, very similar to the way they were in the past. One of the things that has been maintained in the new bill. Maybe some folks don't know about this. A lot of the questions that I always get about 529s is, well, I don't know if I want to set one up because I don't know if my child's going to go to college. Well, one of the great things, and there were always options that you could do before this thing came into play, but what they've maintained is that as long as the account was open at least 15 years,
Okay.
you have now the option to basically roll over up to $7,000 a year into a Roth IRA for those children. So there's a use for it with a maximum limit of $35,000 lifetime per beneficiary. But that's a great way to get a child started in a Roth. And now you have something that you can do with those 529 accounts. The other thing with the 529 accounts is they've expanded the use of those accounts. These are really big things. So number one, if you have children that that are in private school or certain K-12 programs, in the old bill, you can only take out as much as $10,000 a year from your 529 accounts. Well, that's been doubled. Now it's 20. And they've also expanded the use of the 529 accounts. So books, it's not just tuitions, books, supplies. Now they've even done credentialing expenses. So if you have to pay fees, maybe if you're going to become a lawyer, maybe you're going to become a CPA, you get to use those out of your 529 as eligible qualified expenses.
Awesome. That's very helpful to know. Let's also chat about qualified opportunity zones. What is that actually?
So a lot of people have been asking about this. So this is one of the policy extensions that I was very happy about because in the past bill, one of the things that you were able to do was if you had a liquidity event or you had a very large capital gain, maybe you sold a piece of real estate or your company, had an exit and you got to cash in a bunch of stock options. You got this huge capital gain. One of the things you could do was you could take some or all of that gain and invest in these what are called qualified opportunity zones, meaning you're investing in economic development in low income distressed communities. And it was a great policy because we were helping to grow our economy in certain areas, and you were going to get a tax benefit, meaning you could defer your capital gain. In the old bill, it was through the 2026 tax year. What they've done now, because obviously that's coming up, is starting in 2027, the program is changing, but it's better, meaning
Okay.
One of the changes is that it's a rolling 5-year plan now. So the moment that you park your capital gain into these funds, you get to basically defer it up to the basically earlier of 5 years or when you sell your investment in the fund. But in addition, you were going to get certain tax benefits the longer you held that investment.
Right.
So, some of your investment, you would also start to get some, exclusion of gains from the investment. But what is great is with the new program and you have 180 days to make this investment. But now there's something that they've created called a qualified rural opportunity zone. And those are in, low income or distressed areas where the population is like less than 50,000 people. And with those, depending on your holding period of 10 to 30 years, if you hold it for 30 years, it's fully exempt, your investment. Done. So this is a great program that they've spiced up. And the thing that I always liked about it is for those of you that own real estate, one of the things that you've always been able to do is what's called a 1031 exchange, meaning flipping a house, and there's rule process you have to follow, but you have to take, in that case, you had to take the whole gain and move it into the new property. But with the zone, you could take some or all of that gain. Obviously, what you don't put in there gets taxed, but that's what I've always liked about this. So it's really important to talk to your tax professional if you are interested in this, because I think that this is a great enhancement to the program.
Yep. And I know that we have a lot of clients who are in that business of flipping homes and needing to have some expertise and guidance. So as Al mentioned, definitely look into that with your CPA or tax professional. Alternative minimum tax. Tell us more about that.
Yeah, so these are for, I guess high income taxpayers. You should be listening really closely here. So the alternative minimum tax, or AMT, is this enigma, meaning most taxpayers don't really care about it. They don't qualify for it. But what this alternative tax regime was set up to ensure that very high income taxpayers are paying a minimum amount of tax to the government. So there are some adjustments that are made with deductions, yada yada, and so what they've done here is, and this is one where you do need to be aware of. It's not very favorable for folks that are subject to the AMT, because the thresholds are going to go back to the 2018 levels. So meaning, if you're single, it's 500,000. If you're married, filing jointly, it's $1 million. So one of the things that I would advise you all to think about, the most common AMT issue, if you will, is folks that have maybe what's called incentive stock options, ISOs. These are different than most stock options, because without getting into too much of the details, there's no taxable event until you actually exercise it. It's not when you get it. So if you do have ISOs and you do have the option to exercise them, I would try to do it this year, not next year.
Okay. And I know there was an item that maybe wasn't talked about a lot, but gamblers.
Yeah, so
there's something that we need to know about, some cautionary advice or recommendations here.
So there are a couple of, I wanted to get into some of the lesser known things. Haven't gotten the same kind of attention as some of the big things like SALT.
Right.
So, gamblers beware. And I can't tell you why they did this. And, I've been in a conference recently and we were all just, scratching our heads about this one. So as those of you that gamble know, when you have gambling winnings, you have to report it as income. But if you itemize your deductions, you can deduct your gambling losses, but only to the extent of your gambling winnings. That was the old way. But now what they've said was, in the new bill, if you have gambling losses, you can only deduct the losses 90% of the gains. So there's a 10% part that you're going to have to pay taxes on regardless.
Mm-hmm. Okay. Yeah, I mean, that's definitely something you want to keep down if you are in fact a gambler.
And the other tip that I wanted to bring up, and I might miss something, Rocío,
no worries, go ahead,
is folks that are thinking about adopting a child. It's a small pool of folks, but there was always this adoption tax credit for any of you that did it, and the max, I think it's the deduction is up to 17,000 plus that you would get. But what they've now added in the new bill is up to a $5,000 refundable component of that. So like the child tax credit, now there's a piece of the adoption credit that is refundable, meaning you're going to get that amount, up to that amount, whether you owe taxes or not.
Okay. Awesome. That's good to know. So we talked a lot about individuals and how this will affect us. Let's get into more of the business side, business owners specifically, starting off with the 100% bonus depreciation.
So, business owners that have capital intensive businesses, or maybe, you might, have rental properties or certain real estate, in certain situations, the 100% bonus depreciation is going to come in handy. But these are for, shorter lived assets.
Okay.
Typically it's 15 years or less. And the good thing about the 100% is it's going to retro back to any assets that were placed in service as of January 19th of this year. Okay. So, for folks that, maybe are looking at throwing off a lot of profits from their businesses and are going to need deductions, and you have the opportunity to potentially invest in certain assets, you should certainly talk to your tax advisors about those. But remember, for folks that own real estate, you have to get tax advice, because there are, in most cases, passive activity rules that you need to follow. And so, as I'll say again later, just because a benefit is available doesn't mean that you're going to be able to really take advantage of it.
Fair. Okay. Research and development. What's changed here? What hasn't changed here?
Sure. And before I get to that, I wanted to add one more thing. There's also another type of bonus depreciation that was called Section 179.
Okay.
And that was for certain types of equipment that had maybe greater than 50% business use, where if you were eligible, that could be bonus depreciated at 100%. And what they've done there is they've actually raised the threshold, which is great for folks, right? Mm-hmm. It's now been raised to 2.5 million is when it starts, and then it doesn't. And so that's going to be a really nice increase, because the cap is gone up, and so you'll be able to Section 179 more of your investments as well.
Okay.
but R&D. So this is
R&D,
another one that people, you know, maybe it's not getting as much, you know, media attention, but
Yeah.
for those of us, you know, that are in the industry and are working with business owners, this was, you know, always, you know, what I thought was, you know, without, you know, I'm not going to get into politics today, but this was bad policy, because what ended up happening was when they added this back in 2022, you know, it really hurt startup companies. So if you are a tech startup, or you have a lot of what's called, you know, qualified research and development expenses, you know, years ago you could expense those in full, but then a few years ago you had to start amortizing them. And so if you had domestic R&D, you had to amortize them over 5 years, and international, it was 15 years. Now, what I will tell you with the new bill, sorry, you know, foreign businesses, but the international R&D has not changed. It is still 15 years. And it may make people shift their, you know, their R&D facilities to the United States. It's very possible. But for folks that, you know, in the US, now you have some options. So going forward, obviously, any new expenses you will, you know, R&D, you will be able to expense fully starting this year. But what about the last 3 years? So if your gross receipts this year is less than 31 million, you may have multiple options. So for everybody, one option is any of the R&D expenses you could write off either over 2025 or spread it over 2025 and 2026. But for folks that have smaller businesses, so below that 31 million number, now you have the option to not do that. You could actually go back and amend those 3-year returns to take the expenses in those years. But in that case, you only have 1 year to do it. That option expires July 4th of next year. But the big thing here, as I said earlier, is you got to talk to your CPA or your tax advisor about trade-off analysis and what makes the most sense.
Okay. And I know we have a few questions that are coming in, so we'll do our best to make sure, number one, we'll get to your answers. It may not be during this webinar, but it will definitely be a follow-up. And so I think, you know, we're kind of at the halfway point here, but I'm having our team kind of patching us in some questions in a little bit, so we might get to those. But let's also talk about QBI and pass-through entity deductions.
Right. So as I said earlier, you know, one of the great benefits the past few years was what's called pass-through entity tax. So as I said earlier, for folks that are going to be limited with their state and local taxes, if you own an S corp, or you have a partnership or a multi-member LLC, you could, at the state level, and every state had some tweaks to it, but you could basically elect to pay the state taxes at the entity level.
Okay.
And then what would happen is you would get a federal deduction on your business return for the state taxes paid, and now you've basically removed it from your personal tax return in full. So that option is staying, and that's great. But QBI was Section 199A, and so what the enhancements there, it's actually really good. So there's a few things. One, the thresholds, you know, have gone up, okay, but what they've now established is a floor. So as long as you have at least 1,000 of what's called qualified business income, you're going to get a minimum $400 QBI deduction on your return. There are also higher phase-in limits for a subsegment of QBI businesses, what are called specified service trading businesses. And that was a certain subset of these types of business where usually if it was based on a certain skill, right? Like, you know, financial advisors, consultants, there are certain industries that were involved. So medical professionals, right? There's a list of them, but those always had a limitation on their QBI deduction. But what they've now done is the phase-in limits have actually gone up. They've actually doubled. So we don't have to get into the numbers, but again, this is just another one of those areas where the thresholds were increased with the tax bill.
Okay. So I think we did have a question related to QBI. I'm just going to double check here. Does the QSBS exclusion, or I guess, sorry, this is our QBI. Are there strategies to maximize a 20% QBI deduction for service-based businesses?
I mean, that's kind of I don't know if it's I mean, it kind of goes both ways,
Yeah.
right? So what I would say is that's the QBI deduction is really a function of your business forecast. And what I always tell my clients is at least no less than quarterly, you should be forecasting the year. So based on that, then you will be able to look at, what your QBI deduction is. But at the same time, if you've had, losses from prior years, so you had carry forwards, then the two are going to offset. So, QBI isn't something that you really necessarily plan for. It's sort of like, if you have taxable income from your pass through and it is a Section 199A business, then this is what it is.
Okay.
And so it just gets added that way. But that's not one that you would necessarily plan for. But obviously, you want to know about it. If it's an SSTB, then yes, that is going to affect, what you can take. And that's why you need to have regular interaction with your CPA or tax professional.
Fair. Okay. And then let's get into QSBS, startup investors. I think this affects them.
Right. So this is another one that people are really excited about. So there was always something called Section 1202 exclusion. What does that mean? If you had what's called qualified small business stock, and that meant, your at the time it was your assets, it was below a certain amount, and there was you met the 5-year holding period. C Corp, you could exclude up to $10,000 of capital. There would be a capital gain exclusion basically when you sold the stock. Now what they've done is it's not, and in the past it was 5 years, use it or, yes or no, meaning if you didn't hold it for 5 years, you got zero. So it was all or none. So now what they've done is they've added steps. So starting at 3 years. So at 3 years, up to 60% can be excluded. 4 years, it goes up to 80%. And then 5 years, it's back to 100. And it's a rolling, thing, right? So, and then the other thing was the cap was raised from 10 million to 15 million. So I think that, folks, certainly C Corps, folks that may have, eligible stock, they're going to want to certainly talk to their, their attorneys, their financial advisors, to not miss this opportunity.
Okay. Something that you talk about, this might be off topic, but you talk about the trifecta, right? And I think that's something that, may not, it's related to this as a whole, right? But what does the trifecta mean, and how can individuals and business owners use the trifecta to maybe take advantage of some of these items that we've been discussing? I'm
glad you brought that up, Rocío, because so when I speak to my clients, I've coined this term, the financial trifecta, and it's a 3-pronged strategy for preserving your wealth. There's a difference between tax preparation and tax planning, tax advising. Okay, so what I've always told people is there's 3 elements. If you do this, you should be okay. One is having a good, CPA or tax professional that you trust that can help you with, tax planning strategies to reduce your tax liabilities legitimately. The second is having a good financial advisor to help you diversify your investments. And the third is having an estate plan. And we'll get into that shortly about how the tax bill affected, estate planning. Okay.
Yeah, I know. I love that. And it's honestly something that I'm looking to apply to myself as I grow with it in terms of, individual, but also just the expenses and anything that my husband and I are needing to keep in mind as well. So let's jump into business interest limitation. Are we saying goodbye to the ERTC?
Yeah, so there are a couple things here, and these are a few things I didn't want to leave out. We're not going to get into the technical. So folks that have passed through know what's called 163J, which was a business interest limitation. And so what I would talk about there is just know that it's gotten better, meaning in the past, the limitation was based on 30% of what's called IBITs, which is earnings before interest and tax.
Okay.
Now the 30% is based on something called EBITDA, which is earnings before interest, tax, depreciation, and amortization, which means now the threshold's gotten more. So for pass-through owners, you may be thinking about this, not so much we need to get into now, just know that it's there, and it's something that you need to be aware of. There is something that I want to come back to that we really didn't cover in depth enough earlier. And really it does have to do with people that itemize their deductions. I don't want to forget this. So there are a lot of changes that are going to start really in January. So one of the big changes here is if you itemize your deductions in the past, you would get unlimited, you can get cash charitable donations, and it was subject to, you can donate subject to 60% of your AGI. The 60% is still there, but for those of you that do itemize know that, like, for example, medical expenses was only deductible for the amount above 7.5% of your adjusted gross income. So now what they've done, and I can't really get into, the policy rationale why they did this, but now what they've done for charitable donations, if you itemize, the first 0.5% of your AGI is not deductible. Only the amount above 0.5%. That's, issue number one for the high, net worth folks. Issue number two is itemized deductions for the folks in the 37%, meaning the highest tax bracket. You're going to lose 2 cents of the value of your itemized deductions, meaning your limitation will be 35%, not 37%. So that 2 cent, the coders that are coding tax software are going to have fun with trying to do this. But basically, there's a whole formula how this is going to work, and those are going to kick in January, which is why you want to do your charitable giving this year. And we'll can get into that a little bit more later, but this is the year to do it.
This is the year to do your charitable giving. I will repeat that again. I think that's very important. So, and
ERC. Yeah. That was the last thing about business. I don't want to forget that.
Yeah, go ahead.
All I'm going to say about the ERC is bye. It's gone. No more. They're not looking at it anymore. Put it in your rearview mirror, but just know that this is one of those areas where they are turning the screws. So normally the statute of limitations on things, as those is 3 years. Well, with these, 6 years. So 6 years from basically the later of the date that your payroll tax return was filed or the date that you filed your ERC claim. That's when the 6 years expires. So just know, folks that apply, they're still going to be looking at these, but they're not approving any new ones. Okay?
Okay. Speaking of estate tax and just estate and gift tax, rather, let's talk more about that. And then we briefly mentioned that we wanted to get into that.
So obviously, the annual gift exclusions, that's not going to change. Currently, I believe it's 19K this year for per beneficiary. But if you are married, you can gift split, so it actually would double if you say your gifts come maybe half from your spouse and half from you. That's for gift purposes, gift tax. But everybody was worried about whether the TJCA was going to sunset. So the lifetime exclusion over the past years has rapidly increased. It was used to be about 5 or 6 million. Now it's about 14. It was about over 14 million, right? And nobody knew what was going to happen. The great thing for folks is the lifetime exclusion is now going to remain at 15 million this year per person. Okay. Now remember, with these, when you hear in the news about these things have been made permanent, those of us that know and deal with policy stuff know that permanent is only as good as the next administration. Okay, so it's permanent for now. For now. Okay, but what it means is that a lot of folks may not have to worry about what used to be called the death tax, but still, things don't last forever. So what does that mean? If you own a business and you're worried about what's going to happen with your business when you're not here, you're still going to want to talk to your estate planning folks about maybe buy-sell agreements. There may be other things. There's still going to be reasons that you're going to need to do estate planning, especially for the very high net worth folks. Okay. The other thing is there is something that most people don't know about called the acronym is DSU. So it's deceased spouse unused exemption. So that means there were certain rules. If you had the opportunity to basically, if you filed certain forms, you could get your spouse's half. That is really important. And I still think that even though it's 15, we were just talking about this. If you're in the 5 million range, you should still be thinking about, these types of estate planning things, because nobody knows what's going to happen in 5 years or when there's a new administration. So, but the good thing is, a lot of folks should be really happy over the next few years because that 15 million number, that's a big number.
Okay. Let's talk about the IRS and maybe the methods that they're starting to use. I think there's some updates about them going more digital with when it comes to accepting or sending checks. And how does this affect us? And talk a little bit more
So
about
there's
that.
two things. So one, there is one other administrative change that I wanted to just mention that people are going to be really happy, especially employers.
Okay.
Because people were up in arms about the lower income thresholds for reporting what are called 1099-Ks, for example. So folks that are using, say, Cash Apps or Stripe, or I don't want to mention all the names, but that are credit card transactions, and those are now going back to the old way. So the threshold is going to be $20,000 or 200 transactions. So the paperwork burden is going to get easier there. But what was outside of this bill, but they announced, recently, is starting in October, no more checks. So the IRS is not going to send you your Social Security benefits or any tax refunds by check. At the same time, you will have to make all your payments, withholding payments for payroll, income tax payments. That's all going to have to be done by credit card, debit card, bank transfer. So everything they are rapidly trying to move to everything being electronic payments. There will be some very, very limited exceptions to that, but I think there could be some disruption here. A little bumpiness in the implementation because this is a really new thing. There are some folks that have never wanted to do it this way. So you're going to want to talk to your tax preparers about making sure that you comply here and that you don't get stuck for any reason.
Yep. Going back to that trifecta. So let's take some time to go over some of the questions that we had come through. Let me go back to the top here. It's a question about SALT deduction. So if I'm married and filing separately, do my spouse and I each get the 40,000 SALT deduction in 2025?
Well, the answer is yes. But remember, if you file separately, you both have to itemize. That was always the same. So one of you can't take the standard deduction and one of you itemize, right? So yes, those things will be split. So again, in that case, I encourage you to work with your tax professional and do some scenarios because I've always been, to me, I talk to my clients about, when should you file separately and when you shouldn't. In most cases, you don't want to file separately because you lose certain benefits by doing so. Because the big thing, remember, and this doesn't have to do with SALT or anything, when you file separately, it's almost like filing single. And when you file single, the tax brackets are narrower. So when you file jointly, you get a lot more benefits, meaning the steps are wider. So when you file separately, you're going to get to the 37% tax bracket much quicker. I encourage you, that type of question, that's one where you should talk to your tax professional about whether you should be filing separately or not. There are some cases where you have to. So let's say you are, a U.S. non-resident and there may be certain situations where you have to file separately. So that's what I'm saying. Talk to your tax advisor about that.
Talk to your tax advisor. Okay. Another question related is how will the phase out for high earners be calculated?
I'm not sure what phase out they're talking about, but that is a very complicated calculation. If you're talking about the itemized deductions, I think it's just 2/37th, and then there's the lesser of. You don't want me to get into the whole mathematical formula. They're working this through now, but just know that if you're in the 37% black tax bracket, the bottom line is if you are not doing tax planning, then you need to because. You are, there's a good chance, and I see this, in many cases that folks are not, that they're overpaying to the IRS and their states. So in my mind, those are on a case-by-case basis. And I think you should talk about your situation and come up with some, mutually agreed upon tax planning strategies to help you lower the tax burden in those higher tax bracket ranges.
Thank you. One question related to the 529 plan rollovers. If my child already graduated, can I still roll over unused 529 funds into my Roth IRA?
It's not, okay, so first of all, it's not your Roth. So that is a no-no. So what you are doing here is if you have a child and they didn't use all of their 529, then you can set up a 520, a Roth for them, and you can roll over the unused funds, subject to those rules I mentioned earlier, into the beneficiary's Roth IRA. Okay, so it's for the beneficiary. It's not for you. So do not do that under any circumstances. And then there are other things that you could have always done. This had nothing to do with the new bill.
Yeah.
You were always able to, if you, let's say you wanted to transfer the funds to another beneficiary's 529, you could still do these rollovers without paying taxes. So there were always options, if you will, but now there's an option where you can, where the beneficiary can still keep that money and have it set up in a retirement account for them. And Roths have always been a great retirement plan if you were eligible to contribute to them.
Okay. Let me look at some more questions related to the business tax changes. Let's see. There's a scenario. If we buy something in late 2025, but place it in service in 2026, do we still qualify for the bonus depreciation?
The answer is no. Sorry.
Oh, no.
People talk about this all the time. It's always the date placed in service.
Okay.
Say it with me, everybody. The dates, the asset was placed in service.
The date the asset was placed in service.
So
Got
my
it.
advice is, if you're going to do something at the end of the year, then you better put it into service that year to get it. If you don't, then you don't get it. So talk to your accountants about those types of things. You should be doing, like I said, forecast regularly. So it shouldn't be a crisis situation where you weren't trying to squeeze something at the end of the year. You should really be looking at, your forecast on a, at least starting in the fourth quarter. You should be doing it, obviously you're going to do it before the September 15th payment, but then you should be looking at it again in December. But don't wait till the end of the year to do your, to try to find these deductions, because that's when, mistakes happen.
Okay. And then there was a question regarding the QSBS. Does the QSBS, you might have already answered this, but does the QSBS exclusion apply to shares I already own or only to new investments? And if we don't, we need to.
I believe it's shares that you already own. I mean, it's based on the holding period. Again, those are things that your CPA or your tax person can verify with you. But yeah, the holding period, it's not prospective. They've just changed, the eligibility for it. So I don't think it's based on, new holdings now. But again, this is something that you should be not doing in a vacuum. You want to talk to your accountant or your tax professional if you are in a situation where you qualify with this stock and there may be a liquidity event coming up.
Okay. And last question we're answering for the live session. Again, if we missed a question, we will make sure to reach out, but we'll share that as our follow-up. But the question is related to the estate and gift tax. If I give large gifts in 2025, will they be grandfathered in if the exemption drops later?
I want to make sure I understand your question. So first of all, the lifetime exclusion, that's for inheritances. That's for inheritances. So your residuary estate, as it's called, so residuary estate usually excludes like retirement accounts, right? Because those just go to the beneficiaries.
Right.
Okay. But if your residuary estate is less than 15 million, then you don't got to worry about it. So you're talking about, gifts is different. If you make a gift to somebody, then and it doesn't matter whether, if you're a tax resident in the U.S., and it doesn't matter whether that person is in the U.S. or they're non-resident of the U.S., you're subject to the gift rules as a U.S. tax resident. So those are, like I said, don't go over those, those gift amounts if possible. But then some folks, even though you have to file the return, you could still go over the gift amounts, because now, at least over the next few years, because the exclusion is so high, yes, you have to file a gift tax return to disclose the gift, but it'll just go against your lifetime exclusion. And it's at 15 million right now. So, you're just filing the paperwork to let the IRS know, but it's so high, maybe it won't really hurt you.
Okay.
But it's never. But again, like everything else, it's a case by case basis. You should always talk about your unique circumstances with your tax advisor or your CPA, and they can give you the best advice about what makes the most sense for you and your family.
Fair. Okay. And we're probably going to wrap up a little bit earlier today, but I just wanted to kind of highlight kind of 3 action steps for individuals and maybe some for businesses as well to kind of start implementing or just to do now. Just feedback on that.
Yeah, it might not be 3, but some of the big things to think about is 1, to itemize or not itemize, right? So I think the trade-offs are gonna change a bit now over the next few years. So given the high standard deduction levels, you may not need to itemize. So again, that's something to be looking at. Give your charitable giving now. So one of the things we didn't talk about earlier was for high net worth individuals. There's something that was called a donor advised fund. Meaning you could set up a fund that would disperse money to charities. And what was so great about that was that, let's say you put $10,000 into the donor advised fund, but the fund only sent out $5,000 to the charities, you'd still get the full $10,000 deduction. Do as much of that, if you have those funds, do it this year. Do all your charitable giving this year, because the floor at 0.5% is going to kick in January. So if you need to lower your tax liability, work with your tax professional, but make sure you get those charitable donations in now. That's one of the big things. Obviously, be aware of the new tax deferred savings accounts if it makes sense. A lot of the things haven't changed, which is giving to charity, saving for your kids' education, right? Saving for retirements. Those things are not going to change. And then the other big thing is the tax brackets didn't go up. They're the same as they were. Okay. So, and the other thing, we didn't really cover, but we get this question all the time from some of the, folks that remember the old miscellaneous deductions back from pre-2018. Just forget about those for another, because those are not coming back.
Forget about
right? So don't ask your taxpayer about unreimbursed, moving expenses, business expenses, legal fees, personal legal fees, tax prep. Don't ask them about that, 'cause none of that stuff is back. It's still gone. Okay. So for the big thing is, make those charitable donations and, look, if you think you're going to be close to some of those phase out limits, then defer certain things so that you don't get subject to them this year, right? Maybe there are some things like, let's say you're thinking about doing a Roth conversion or something where you could have a huge pop in your income this year. Well, maybe spread it out over a few years. Well, what some folks do is what's called a qualified, retirees may know about, it's called a QCD, where you can send some of your retirement funds right to the charity. It's right off the top, so you don't even see it. So what I'm saying is, if you think you're going to be close to jumping up tax brackets, then be careful not to do things that could inadvertently put you in those tax brackets. Okay. Now, businesses is different. Like everything else, I said it before, I'm going to say it again. Just because there was a benefit added with the tax bill doesn't mean you are eligible for it. So you need to do your forecast, and you need to look at, for example, we talked about, people have already been asking, the ink was barely dry, and we had clients asking us about the R&D. Yeah. You got to look at your options and see what makes the most sense there, right? Looking at bonus depreciation, for example, looking at folks that are starting new businesses. Continue to talk to your tax advisors about which entity makes the most sense for you, right? And the other thing we didn't talk about earlier is we didn't really cover a lot about C corporations. So we talked about that charitable donation threshold for individuals. Well, for C corps, they've now added a 1% threshold. So the first 1% of charitable donations is not deductible, but the cap is still 10%. So 10% of a C corp's taxable income that's the maximum. So at the end of the day, all of these things, I encourage you all, whenever you're not sure of something, seek professional advice.
Great advice and recommendations that we've heard today. I know I learned a lot personally, and I'm looking forward to continuing to learn more from you, Al. As we've kind of gone over this new bill act, the One Big Beautiful Bill, has created a lot of opportunities, right, for both individuals and businesses. But there are some deadlines, as Al has, mentioned. So the earlier you plan, the more that you can benefit. And of course, using Al's method of having your trifecta is also helpful to have those professionals and experts in those areas. So Al, just kind of closing up here, how can someone reach out to maybe Manay CPA? How can they reach you? What's the best way for them to maybe even set up a free consultation just with you?
Well, obviously, as you all know, you can go to our website, www.manaycpa.com, and you can fill out a form. You can, certainly call our office and, set up a complimentary 15-minute call with me, and we can learn about your situation and then see whether you do need, tax planning. Most people forget about tax planning, but tax planning is so important on the front end because I tell folks, you'll be happy you did this, right? Because everybody wants to preserve their wealth legitimately. So, our tax code is complicated for a reason. And the reason is it keeps folks like us in business, right? But, wait until it's too late, right? So we've got still 5 months of the year to go. 4.5 months. There's a lot of time for you to plan because there's a lot of things changing. Some of it kicks in this year and some next year. But it's really important that, you're hearing a lot of noise about all these things. But if you're not sure how it affects you, talk to somebody because it'll be the best investment you made. And it could save you multiples of that later if you just get the right advice from the tax professional that you can trust.
Well, Al, it's been a pleasure. Again, this is Al Meyers, CPA, with more than 20 years of experience. And so thank you so much, Al, for your time today. It's definitely been super helpful. Again, as a follow-up, we look forward to following up with everyone who registered and was able to attend, or even maybe wasn't able to attend fully, on some of the items and some of the questions that came through. But other than that, we will be signing off for now, and we look forward to seeing you on the other side. Thank you so much.
Thanks, everybody.
Bye.